thanks to you, Mr. Yvonne, and also to our previous speaker, Mamelo Thulare. Both of these speakers are available to connect. So again, to participants, this is BiSPA 2020 is an amazing opportunity for you to network. You never know where your next mentor could be from, or could be where your next gig could be. So don't sit back, don't be laid back. Opportunities are there to be taken. Go out there, familiarize yourself with the speakers in the chat window. Feel free to share your business links and all of that. So now let's jump on to our next session. We are supposed to have Francois Fouche, whom I'm going to assume is a fellow French speaker like me, at least based on the name. Donc, bonjour, François Fouche. Très heureuse de vous avoir sur le plateau aujourd'hui. He is the director of Growth Diagnostics in collaboration with the Northwest University Business School, and he will be talking to us about economic impact of the pandemic and emerging trade opportunities for African countries. Francois Fouche, bienvenue, welcome to BiSPA 2020. I see you around. Are you ready to take the microphone? If yes, please put your video on, unmute yourself, and take the floor away.
I am indeed. Thank you very much. I've shared my screen in the meantime, MC. Can you just give me an indication whether you can see it and whether you can hear me, then I can get on with it straight away. Fantastic.
We can see you clearly, we can hear you clearly, and yes, we can see your big purple screen on your presentation with the pandemic's economic impact. So please, yeah, take the floor away and let's learn as much as possible from what you have to say.
Thank you very much, and thank you very much for the opportunity, and also to Sol on here. Thank you, Sol. It's good to be with you guys this afternoon. MC, just a correction there. My name and my surname can be very deceiving. I do speak no French, unfortunately, which is a terrible thing. I know, but it's a very, very long story. I'm going to share with you what we believe was the economic impact of the pandemic, in particularly as far as it relates to Southern Africa. Also going to share with you some of our thoughts and new research about new emerging trade opportunities that have emerged due to the pandemic, and some of them have also existed prior to the pandemic. And there are some very appealing options out there at the moment if you're willing to scratch a little bit deeper than the surface level. Let me go click on next. So before we start, I'd like to just ask you to please keep an open mind regarding what I'm going to share with you this afternoon, for the simple reason is that your mind is like a parachute. It is most valuable when it is open. If you're going to listen to what I'm going to share with you this afternoon with a closed mind, I don't think the message will get across. So if we look at the World Economic Outlook from the IMF, until January this year, the IMF was still expecting more than 3% of real GDP growth for the globe as a whole. Then the pandemic set in sort of middle March. It's spread very quickly around the world, originated out of China, and the growth forecasts have been downgraded quite significantly. The latest one from the IMF in October this year had real GDP at a global level contraction forecasted for about 4.4%, which is a phenomenal contraction if you think about the fact that it's the global GDP. It's for all the countries around the world, and on a real level to contract at this level is unheard of. So coordinated responses are required where we are right now. And this is the worst crisis since the Great Depression that started in 1929. And it will take significant innovation on the policy front, both at the national but also at the international levels in order to recover. Having said that, what we've seen transpired since this onset of this pandemic is exactly the opposite when it comes to trading across borders. This is an illustration or chart rather, that illustrates the number of temporary trade restrictions that have been imposed on medical products since the start of the pandemic up until sort of the middle of June. And you can see most of these, the number of active measures, i.e. countries preventing PPE, personal protection equipment, products being traded across borders is a horrible thing in terms of international trade and in terms of a lack of international cooperation. Why does this matter to South Africa, for instance, as an example, and to many African countries? If you're a very small but very open economy, you rely a lot on goods traveling across your borders into your country and out of your country in order to make the economy function properly. So if there are preventative measures put in place at other borders around the world, it makes it increasingly harder for you to obtain whatever is necessary in order to continue to run a functional economy. Before we carry on, I would like just to paint a little bit of a background and paint a canvas for you in terms of the global environment that we face today. And we refer to this as the so-called globalization. And what does that mean? Well, it comes from the fact that globalization is in fact in retreat for the first time since the Second World War. If you look at the period there prior to the First World War, 1914, you'll see that the industrialization and integration area led trade openness around the world to increase slightly. Then we had the First World War, we had the Great Depression in the middle, and we had the Second World War, and the trade openness levels in the world declined significantly. We had an establishment of a new world order after the Second World War, and we had this post-war rebound period. We had trade liberalization among emerging markets, and China joining the international arena, and China joining the WTO eventually in 2001, and tariffs that have declined across so many different countries and jurisdictions. And we've had this booming trade and globalization taking place until 2008, 2009, with the global financial crisis, and then we've had the onset of globalization. So when you look at the world today and you look at new trade opportunities, be aware of the fact that we are a less open world today than what we were prior to the global financial crisis of 12 years ago. It doesn't mean it's impossible to trade today. It just means there's a little bit less trade compared to global activity as measured by GDP taking place. I think what is very important, given that we find ourselves in a very deep recession due to the pandemic, it warrants that we ask a very important question, and that is, what is the real crisis? Is the cure, in fact, worse than the disease? And what I mean by the cure is, are the economic lockdowns that we've seen in so many jurisdictions for so many months not, in fact, worse than the actual disease? And should we be fearing the virus, or should we rather be fearing the way we react to the virus? And I think it's probably the latter, as we've seen from so much evidence, especially on the economic side of things. And the reason I say this is because there's probably a less than 10% chance that some people may die from this virus, but there's a 100% chance that millions of people will actually starve to death due to the so-called cure, i.e. the economic lockdowns. If we start preventing people from going to work or looking for work or leaving their homes in order to do that, and we don't have the social safety nets in order to catch them, if they have to sit at home without income, it becomes a very, very difficult situation very quickly. And just to put that into perspective, over 500 million people are expected to go back into poverty around the world due to the deep recession that we are experiencing right now. This is a chart from Oxfam that was released very early on in the onset of the pandemic, and they've modeled in this instance sort of a reduction of a 20% income caused by the COVID-19 recession. And you can see there in sub-Saharan Africa, the expectation is for between 40 and 50 million people to go back into poverty due to significant declines in income. What can we say about the pandemic's impact? Well, this won't stop human progress, but it certainly will interrupt it. The global economy has gone to hell in a handbasket, and it happened all overnight. This is, as we refer in the literature, both a demand and a supply shock to the economy. It's very similar to the oil price fallout that we've seen during March and April. This shock is different from the previous shocks we've had. This one is all front-loaded. The global financial crisis in 2008 was about 18 months of bad news. The Great Depression, which started in 1929, was a far more gradual release of bad news over a period of about 3 years into the global economy. But with the current pandemic, within less than a month, stock markets, commodity prices, export demand, remittances, which are crucial for developing countries, especially in Africa, capital flows, credit market liquidity, credit spreads, employment, consumption, investment, capex, tourism, all have been in free fall. And it will be a very gradual battle to resurface again. So we've seen a very synchronized downturn, but the lifting of the lockdowns are not so synchronized. And that is where global value chains are finding it very difficult to coordinate these days. So global supply chain interruptions will suffocate certain industries, and the ones that we are seeing are being suffocated the most at present is international tourism travel. What can we say about world merchandise trade volume over the last 2 decades? You'll see that the trend, the pace of increase in merchandise trade volume prior to the global financial crisis was at a certain level. Then the GFC happened and it slowed down after that. Now the pandemic has happened and we suspect it will probably continue to slow down after that. The latest numbers that we've had from the WTO, the World Trade Organization, at the global level, at the global scale for September, indicated that trade has rebounded very, very quickly. Not back to the level where we were prior to the pandemic, but getting there very, very shortly. If we look at some higher frequency indicators to determine how far are we back in the rebound or in the recovery, one that we can keep an eye on is global commercial flights year to date. And this chart illustrates in the red line the intra-EU global commercial flights that have taken place. You'll see that intra-EU travel on aeroplanes came back faster than in other parts of the world. For instance, normal international flights and international flights, excluding the intra-EU area. The reason I make mention of this is that this is an indication that if you drop borders between countries, more people cross borders, more products cross borders, and more capital actually cross borders. Why is this relevant? This is relevant because if we look at globalization, if we look at free trade, what Africa is doing at the moment is exactly the opposite than what is happening in the rest of the world. Under the African Continental Free Trade Agreement that we will start trading under from the 1st of January next year, Africa has decided to do the opposite. Africa has decided to say, let's get together, let's drop the borders among African countries, let's increase intra-Africa trade. Not following the UK example where they want to step out of the EU. And looks like, from the news that I've read this morning, looks like the UK and the EU have struck a deal, and the UK will in fact exit the EU member area at the end of this month. We've seen since Donald Trump's arrival in the White House in 2016, fortunately he's been kicked out in the meantime, trade skirmishes, especially between the US and China, has risen to all-time new highs. So this initiative from the African Union to embark on a journey of dropping obstacles at the borders for to allow more and to encourage more intra-Africa trade is a phenomenal concept. It is a noteworthy development. I'm very impressed by it. I'm highly supportive of it. I am a little bit concerned about the implementation successes that we are most likely to see or experience during the CFTA during the first few years, because I think what is on the top of the agenda at the moment, not only among African countries, but in many countries around the world, is just dealing with the fallout of the pandemic, which makes it a little bit harder to pay attention, for instance, to free trade issues. But nevertheless, this is a great initiative, and I would also encourage you to support this with everything that you possibly have and can. Many people have said to me, Francois, if you look at what has happened globally, then there are very few trade opportunities left, and I'd like to disagree with those people for the simple reason if we look at some world manufactured goods trade by product, and we look at some statistics for the second quarter of this year, and we compare those statistics with the same quarter of last year, i.e. year-on-year growth, we'll find that even though the second quarter in this year was the worst recorded quarter in the history, since we've actually started collecting statistics, we've seen that commodities like textiles, computers, integrated circuits, and pharmaceuticals have actually increased in terms of global trade compared to where those levels of trade were last year. So, of course, this has not been true for automotive products, for footwear, for iron and steel, and for industrial machinery, for instance. But textiles, because we had to make masks, and if we don't have material, those materials have to be traded across borders. Computers, well, all of a sudden, many people are working from home. You've got to manufacture those computers, so you need integrated circuits that go on the inside of those computers. Pharmaceuticals, well, this is a health-related crisis, so we need to buy medicines. So there are still opportunities, even during the worst quarter in history. there have been opportunities of growth. It's just that the opportunities are not where they used to be. They're slowly but surely recovering, going back to where they used to be, but we've had this very large disruption in a very short space of time. So action is required. And as I like to say, is that these are exceptional times and it requires exceptional action. And governments have to do whatever it takes, but they must make sure that they keep the receipts, especially of those rescue and recovery packages that are being dished out around the world. We are at war. The only problem is we are at war with ourselves to a large extent. There's the COVID-19 storm. There's the South African President Cyril Ramaphosa with emergency measures and umbrella, and there's the country of South Africa asking, will it be enough? This crisis came like a bolt out of the blue. Nobody expected this. Local leadership here in South Africa has been very quick on the health management side, but the real leadership test at the moment is out with regards to the economic rescue and recovery. And it's a real battle at the moment. I'm going to offer you a couple of pointers in terms of how to think about the pandemic. This is the largest shock to the global economy since the Second World War, even for countries with very little COVID-19 infections. And countries that prevent additional economic infection will be the best off. It has now moved. It's no longer a health crisis. It has now become a fully blown economic crisis, and we have to stop the economic infection spreading from one country to another. However, there are crisis management challenges that are in fact compounded by huge gaps in knowledge and information during this time. And there's sort of three different levels. The first one is the most acceptable, and the last one is the most severe one. The first one being there are many things we know at the moment that we don't know. And the reason this is sort of acceptable is because at least we are aware of these things that we don't know. Then the second one, which is a little bit more serious, is that there are many things we don't know that we don't know. So we're not aware of the stuff that we don't know. And then the last thing, which is the most dire one and the most severe one, is that there are many things that we know that are simply just wrong. We can sort of metaphysically be aware of these things, but we have to make decisions regardless. And that makes the decision-making process very challenging. So there's overwhelming uncertainty in the process of decision-making at present. At the same time, this has presented a policy space problem for so many countries. And I want to share just sort of a silver thread that runs across many macro economies at the moment. Governments want to run large deficits at present, large fiscal deficits, and they want to abandon fiscal responsibility. And I think that's a good thing. I think government should send a signal to the private sector is that we are investing, we are spending, so the private sector can see that type of activity taking place and gain some confidence in order to join them. But they also want the private sector to run large deficits at the same time, to run negative cash flows and borrow from the banks in order to keep payroll going, and to do this until the economy actually revives. But what do we know from macroeconomics 101? We know that the public and the private sector deficits actually equal the current account deficit of the balance of payments. And that simply means is how much a country is spending more than what it is making. So the current account deficit, however, needs to be financed. Otherwise, you cannot run it. Now, how do you do that? Well, you issue foreign liabilities in the form of loans or bonds, or you liquidate your foreign assets that you have. South Africa's instance, we have more than $50 billion of foreign assets. I'm not suggesting we use those assets, not at all. Those assets play a very particular role because they in essence represent the FX pool that we have available that we need to tap in again if we want to pay for imports. Here's an indication of the South African current account deficit as a percentage of GDP over the last 2.5 decades. You can see South Africa has been running a current account deficit, so in some years a larger one than in other years. With the exception of 2 years, we've continuously run deficits. And I think the current account deficit during this year and during next year will be very large, very deep. However, here's an illustration of what Botswana's current account deficit as a percentage of GDP looks like. With the exception of a few years, they've been running surpluses. It's unlikely that they'll run a surplus this year. I think they'll probably also go into a deep deficit. But it does not mean that all African countries are on the same boat in Africa. So if everybody's running to the market in order to finance these deficits, are we looking at a global debt crisis? Here is a chart that illustrates the general government debt as a percentage of GDP about 2 years ago. And you can see Japan has been running debt levels compared to the size of the economy of about 2.3 times. Italy close to 1.4 times, the US more than 1 times the size of the economy, and then some other OECD countries in there. There are, however, 2 factors that determine whether countries fall into a so-called debt trap. And those 2 factors are, the first one is the cost of debt. When the interest rates or the interest rate burden that you pay in order for the luxury to have the debt becomes increasingly larger, you are at risk of going into a debt trap. The other factor is that if you issue currency not in your own, if you issue debt rather not in your own currency, but in hard currency, you are exposed to depreciation risk. And that FX risk, especially for many African countries, can be very, very real. We've already seen on the continent a few weeks ago that Zambia have defaulted on some of their, I think it is euro-denominated international debt. So this is a real challenge, and debt restructuring will be is already starting to be at the order of the day. Again, this is not the case for all countries in Africa. This is Botswana as an example. Botswana is a phenomenal country, phenomenally well-run country, concentrated economic activity, concentrated exports, which makes it very exposed and can perhaps rock the boat from a resilience point of view. But Botswana's debt levels increased after the global financial crisis as they tried to revive the economy. And debt levels will probably spike this year, next year. But Botswana, for instance, is in a much better position in order to weather the current storm. So there's a war-like effect on debt, but there is no war taking place. Fortunately, what we can tell from history is that this is familiar territory. If I just measure it by these 2 examples, if you look at the government debt as a percentage of GDP levels for both the UK and the US, you look at just after the Second World War in the late 40s, British debt levels spiked to about 270% of GDP. US spiked to more than 1.2 times. Subsequent to that, GDP grew much faster than the debt load. And because that happened, the ratio sort of self-adjusted. The forecast, which is a couple of months old, which will be much worse than what you see over here, indicates that debt levels are going to spike significantly. It is therefore becoming very important that many countries, or most countries around the world, that want to get out of these debt levels need to create an environment, enabling a business environment, so that GDP grows at a faster rate than what the actual debt level above the line of that ratio grows. And I cannot emphasize this more. So South African funding costs, for instance, to give an example, have escalated phenomenally since the outbreak of the pandemic. To put it into perspective, if we take South Africa and we compare it with Nigeria, the 2 biggest economies on the African continent, we see that South African debt, local currency denominated long-term debt, and the equivalent on the Nigerian side. South Africa has always been, it's always been cheaper for South Africa to go to the international markets in order to borrow money. But South Africa's fiscal management position has deteriorated to such an extent that well, during July this year, it was cheaper for Nigeria to borrow money in the international capital market at similar duration than what it was for South Africa. I mean, this is a very clear sign from the international capital markets sending to South Africa to say, we are not happy with the way that you are running your fiscal affairs.
Okay. So I'm hoping that you can wrap the rest under 2 minutes, because we have Namat, our next speaker, who's already ready on the line. And yes, we have a question, sorry to cut you, we have a question from Komoto Talane, who asks, are the slides available for distribution?
Yes, they will be available for distribution.
Fantastic. So kindly wrap this up as quickly as you can, and feel free to share your contact details in the chat window, so that the people who want to get the slides for distribution can also have access to them. Thank you.
No problem. Let me quickly wrap up in the last minute and a half. I want to come to the last point here, is that we have seen the US-China trade conflict playing out over the last 2 to 2.5 years. We were concerned that it would go to something beyond just a trade war if Trump had to stay on in the White House. Fortunately, it looks like that's not going to happen. So where are the opportunities? The opportunities are here for some African exporters that all of a sudden have cheaper access to the US market and cheaper access to the Chinese market compared to US and compared to Chinese exporters. Why? Well, firstly, because of depreciated currencies all of a sudden, which is good for exports. Secondly, because the bilateral tariffs for thousands of different products, for thousands of different tariff lines between the US and China have all of a sudden made a trade between the US and China incredibly expensive. Those very tariffs, people, are not being applied between African trade and the US, between African trade and China. So all of a sudden, some African exporters can be competitive compared to Chinese exporters if they target the US market, and vice versa, can be competitive against US exporters if they target the Chinese market. That is what I want to conclude with, and those are my contact details. And apologies for, I don't want to run over my time. Those are my contact details. More than welcome to send me an email, more than welcome to send me an SMS or WhatsApp. If you want to get onto our email list, if you want to get onto our WhatsApp list, please reach out and contact us. And I'm more than happy to put you onto those lists, and you'll get regular communication and sort of research snippets that we share from time to time. I also talk a lot at many different conferences around the country and around Southern Africa. We do quite a bit of work within SACU and SADC, so more than happy to to engage in conversation after today. MC, what I'm going to do, I'm going to stop my screen share now.
No, that's what I was going to say.
Okay.
Because we are going to take 2 questions before we move to our next speaker, I want you to keep this slide so that anyone who is watching at the moment can be very smart and take note of the email address and the WhatsApp number. So yes, to the audiences, if you want to get the slides from Mr. Francois Fouche, please make sure to note down the email address and WhatsApp numbers that you can see right now on the screen, whilst we take 2 questions from John Kondowe. So first question, could we say that this epidemic has exposed the inadequacy of decision support systems at all levels? And the next question is about PPE manufacturers have been major winners of this. Are they going to likely use, what will be the likely use of this windfall income? So we're going to try and keep it very, very short because we have our next speaker already on the line. So yes, please go ahead with your answers.
Thank you, MC. With regards to the PPE windfall, that is very true. I'm not too optimistic about that something great will come from this, to be honest with you. I think it will get absorbed into the system for the simple reason is that many people ask, are we going to see an L-shape recovery? Are we going to see a V-shape? Are we going to see a W-shape? We're not seeing any of those. We are in fact seeing a K-shape recovery. And what I mean by that is industries like PPE manufacturing, for instance, is like the letter K. They've jumped up, well, they never actually went down. They just sort of escalated upwards. And other industries like international tourism, like hospitality, like bricks and mortar retail during the most strict lockdown months have just basically collapsed. So the windfall that we've seen on the one side and the fallout that we've seen on the other side, I think will cancel each other out. There are so many mask manufacturers that have expanded capacity. I think we're going to sit with a surplus mask manufacturing capacity if we don't, or very soon, if we don't have that already around the world. I am not too concerned about the second wave, to be honest with you. I think the first wave taught us enough things that we shouldn't be concerned about that. And the vaccine developments, that is absolutely phenomenal. So much money and so many smart people have been thrown at that I'm not surprised by the very positive early outcomes that we've seen so far. Of course, it will take many years for every people around the world to be vaccinated. Not many months, people, many years. The global coordination challenge that we face in order to do worldwide vaccinations is not something insignificant. I hope that answers it. I can't remember the first question now. I can only